Hey everyone, my name is Simon Misiewicz from Optimise Accountants, and we're going to be starting tonight's session all about property investing and property tax, and welcome to all. Just some housekeeping rules. If you don't mind, I'm going to be moving everything to live chat as I can see it, so hopefully we can get some Q&A going on during the sessions, and hopefully I can answer those as we go along as well. My screen's just decided to freeze, which doesn't really help me at all. But if you do have any questions, make sure that you do type them in the video, just the comments box below, and we'll make sure that we go into the answer sessions as we go along as well. So good evening, one and all, and thank you ever so much for joining me tonight. To see a few people now joining me on the YouTube live now. So I'm just going to wait for some other people to go in. As usual, the format of these sessions is 3 sections. The first section I will be talking about in the news. So I've been reading a lot about buy-to-let investing in the news, as well as buy-to-let tax in the tabloids, and I'm going to be feeding back what I've been reading and give you some insights as well to that. Second section will be covering off in terms of the client Q&A. So this is the questions that our clients have been asking and some of the answers that we've been feeding back to those clients in the hope that they can invest in property more with greater wealth and less tax. And the third section is really over to you guys. So it's open Q&A, and if you've got any questions, then I'll be answering those questions live with you tonight so that you get the most out of this session. You can always look back over this session as well, so make sure that if you do find something interesting, you can always go back to it whenever you want to, and then that will give you, at least you don't have to worry that I'm going too quickly or too slowly for you. You can easily catch up. Let's make a start on the what's been going on in the news. Interesting insights this week, a lot different from last week when I did this opener. Last week it was all doom and gloom and really negative about property investing, and the insights I was reading this week was quite different, in fact. So I was quite surprised. It was pretty much focused around mortgages more than it was in landlords and particular tax situation going on. So let's start with the RLA. One of the things that they was picking up on was the greater aptitude for mortgage lenders to be hungry in the marketplace. We've noticed that Virgin, for instance, have increased their cover, the mortgage interest cover, back to 145% from 135%, which basically means that if you had £1,000 worth of mortgage, they've gone down from 145% to 135%, not the other way around, forgive me. So this regard before, if you had £1,000 worth of mortgage interest, previously Virgin would want you to have a rental income of £1,450. Well, that's now dropped to 135%. So now they only require you to have rental income of £1,350. Kensington have dropped their interest rates because of Brexit and uncertainty around the property investor market. And Santander have also increased their term from 25 to 40 years. And that story, funny enough, of terms extending beyond the 25 years means that there are going to be older buy-to-let investors, which we'll cover off another topic, because that seems to be a common thread, in as much as that the landlords of today are much older than they were before. Interesting insights, to say the least, and why that's happening. Now, I've just noticed that there's a couple of people that have joined, but not everyone, which is kind of surprising on the registrations. But anyway, so in terms of what the other news articles, which was again positive, there wasn't much negativity at all going through, which seems to always put quite a lot of publications out in the ether nowadays, and a very similar kind of subject around mortgages was on there, and they cited that Coventry Building Society had increased its maximum buy-to-let borrowing to £750,000, which is seems to be quite a significant chunk of extra funding that they're willing to give buy-to-let property investors. And Kent Reliance have now also, and this is again being cited from which, have increased their borrowing to 85%. Now, typically, I know very much of most mortgage companies will loan up to 75%, but an increase of 85%, that's quite daring for any company. I mean, it doesn't give much leeway if the market does fall, that it doesn't give them much room for maneuver from a risk perspective. So it's quite an aggressive approach by Kent Reliance, but gives more opportunities for buy-to-let property investors to get more money out of their investments. Money Week, again, always an interesting set of articles from Money Week, but this time around, they were citing the fact that there was 120,000 less landlords from 3 years ago, so within a 3-year period, and that was cited from Hamptons International. But 120,000 less landlords than we did before. Well, that's quite an incredible kind of number to see fall, unfortunately. Whether we will see much more of a fall, I'm not sure, but yeah, that was a bit of a crazy number, to be fair. And it was saying that the landlords are leaving the sector, but even though they're leaving the sector, they are leaving the sector with good, handsome profits, because right now the buy-to-let property seems to be at the highest point, bearing in mind we're in Brexit and the fears that property prices might go down. Now, if you are thinking about selling your property investment portfolio, now it seems like that could be the best time to sell. I'm not buying that necessarily. I think that I've read a few publications this week saying that property prices are going to fall because of Brexit. Yes, maybe that could be the case, but for how long? I think that's always going to be the question. We live on an island, and that's not going to increase unless someone else is telling me different. Population is increasing, so unless something's changing there, I don't know. But the demand is going to require pricing to go up at some point in time, which again came on about new market research saying that there's an increased number of buy-to-let mortgages going ahead, but most of them are older applications. So 55 now, people are over the age of 55 account for 40% of the buy-to-let mortgage portfolio, which is a significant age if you think about it. Most people that get into property, especially when you attend courses, networking events, typically could be between 30, 40 and beyond, of course. But there's a lot of people that are younger, but 40% of the markets are over 55 and could be more, especially when you see banks now beginning to increase their term from 25 to 40 years. Inevitably, that means buy-to-let investors may well be older. So feel free to, if you've got any questions and you're listening in to me right now, please feel free to type that into the live chat. I will be answering your questions as we go ahead from this event. So my screen's frozen again. So feel free to do that. If you're listening and you haven't subscribed already, please do so. Just go into the subscribe button and make sure you press that, and the notification button as well, the bell, that is, I think, to make sure that you're updated on every upload that we have. We have this session, but we also have live videos on Thursday as well. Let's just go into property tax news. And again, very similar. So I always look at what's been said in the news in terms of buy-to-let investments, but I'm also looking always for buy-to-let tax. And again, very similar nature to last week. In fact, it was downbeat last week. It was pretty much saying people are leaving in droves. It's the worst thing since sliced bread. And it's just an interesting dynamic when the press always kind of go from one emotional heartstring to another. And I think that we're finding the same again, which have come out talking about, we've already had the discussion about buy-to-let investors being older than maybe before. And the terms of mortgages are extending, so inevitably there will be a bigger age. Well, which, funny enough, have gone even further to say, well, this is because people are freeing up their pensions taking cash out of their pensions because they don't necessarily trust that pension, or they're not feeling as secure. And what they're doing is cashing out of that because it's easy to do so. And then they're buying buy-to-let property investments in their own name. You know, is that going to be a trend? Who knows? It could well be. And Section 24, I think the mortgage interest certainly is going to have a damaging effect. But actually, there's quite a lot of people that are happy to be basic rate taxpayers and to live off maybe 2,000-3,000 a month, and maybe not. Section 24 may not affect those people. So we may see a different demographic coming into the marketplace from than ever before. Which again, I'm not a, by the way, which aren't the sponsors of this channel, but they do write some really interesting stuff. Which on another piece said that tenant fees bans is obviously going to be in place, and there are £5,000 fines for breaking those rules and regulations. And there may be a few people that aren't aware of this tenant fee ban being passed back onto the tenants. And therefore, these whistleblowing tenants could get people into a lot of trouble. So that's an interesting insight. The Motley Fool, I don't really read too much of their stuff, but there was a couple of things that came in. And they was pretty much the only one this time around saying that buy-to-let is definitely doom and gloom and we should all leave. Compared to last week when 90% of everything I was reading, I was reading their stuff last week, pretty depressed. And having to try and inject myself with positive energy. This time around, it was the Motley Fool was the only one to say that you can get better returns buying into shares. And I think that the thing is for me is that there is a sentiment of buying properties is something that you can control, as opposed to the FTSE 100, which even the people in the business don't control the share price. It's the analysts in London that determine what those share prices are. I used to be, unfortunately, an accountant for a couple of companies that was listed in the FTSE 100. And the meetings that I used to attend was pretty much we would have to write a budget and a forecast based on their expectations, not or even our own. So you could tell it was very heavily manipulated in terms of what the city analysts wanted you to document and write about in your own budgets. And therefore, I don't think I would put my faith in shares, if I have to be honest. I don't trust analysts. I'm going to go out and say it. I think they are manipulators just to get to what the other thing to bear in mind in here is, I've always said this, is who's driving the Bentley? Is it you, as in the people that they're asking to invest in these stocks and shares, or is it them as analysts and merchant bank? I don't know, but I'll leave that for you to decide. Another positive aspect, again, the Scotsman, this is really nice reading. I've always said this for some time, is that the Scotsman, not the publication, was saying that Glasgow, the average house price is 129,000, and yet you can get rental income of £10,000, which is a significant amount of income when you think about it in terms of what the property prices are. So the rent yield is, a good rent yield. They were saying pretty much that you can get a lot of your return on investment on these property prices. I've always said that Scotland could well be the area that we should look into. It's just further risking your profile, especially if you live in London. It's a long way to go and see a property. But then again, you can just get a flight for £100, £200 nowadays quite easily. So sometimes it's not so bad. But they was pretty much saying that that house pricing in Scotland is pretty cheaper still than England, and the return on investments are very attractive. And I would have to say, yeah, I agree. It's a good area to have. iExpats is not a one that I frequent in terms of the reading, but they had an interesting one saying that tenants are getting a bit more, not demanding, but they're open to more luxury items. I've certainly seen this in Nottingham, whereby students are now got gyms. I've just drove by another area whereby one block of apartments now has a cinema. I've never ever seen this kind before, where you've got a cinema and a gym. But there are certainly avenues for this now. Bigger companies obviously using these build to rent schemes, and as a result of putting things in place which the so-called amateur landlord may not be able to put in. But the one thing I would say about the aspect of property investing is start to look at your client markets. Who are you serving? And if you've got students, for instance, do think about putting a study room in there, and even shelving for books to be put on there. Make sure you've got good docking stations, good brought for plug sockets and stuff like that, printers, and maybe even set up a hub for it. If you've got professionals like doctors and nurses, for instance, and they're from a medical background, make sure that the place is really quiet during the daytime. Make sure you don't have students living with medical professionals, because that would just really annoy each other. So think about, if carrying on from the medic side of things, make sure that you have some sort of quiet area for doctors, that the doors are double, almost like fire doors, so it keeps the noise out, so that they can sleep during the day between shifts maybe. And even think about putting coffee little machines in the bedroom, so when they're waking up, they can get a quick coffee. And it doesn't have to cost a fortune to do these things, but it will attract you, I think medical professionals in this example will be more attracted to you if you can at least guarantee a good sense of sleep. Now, you can't really always guarantee it, but you can always say, look, these are measures that we've taken to make sure you do get a good night's sleep. So do think about your customers, because I think for some companies, we were always looking at these big buildings at the minutes whenever I'm driving into work. And I'm just marveled the fact that they are building these cinemas. They've got, one of them have got a laundry as well, cinema, a gym. Think about your clientele. We're in changing times. Years ago, you could get away with having a room that's just magnolia. Then you had to soup it up with good beds, mattresses. Then you had to soup it up again with nice interior, nice cushion style paintings on the walls, stuff like that. And now I think we're going to that next step with tenants to say, look, I'm going to give you extra features. Even if that was some sort of concierge service, that would be probably the way to go. Sorry, just seeing one's being held for review. So I can say show for that. Sorry, I'm not sure why, but that's all a question. I will come to your questions later on, I promise you. If you've got questions as I'm going through my reviews, then please feel free to go type those in, and I promise you I will go through that in the third section Q&A. So yeah, put some positive stuff, guys. It was nice to read it this week. I'm pleased that, and I'm hoping that next week will be even more positive about property investing, because I still think that there's good room for investing in property. I think it could supplement your income. It could certainly help you with capital growth, and it's certainly the one way to go. I'm just going to move into section 2, which is now client FAQs, and then the third section is your questions and answers. So I will be coming onto your points. But again, if you do have questions as I go now into the client FAQ stage, then make sure you type them in the chat box down below, and I will get back to you on those. And equally, I've just noticed that it's gone back to top chat. I don't know why it's on top chat. I'm just going to go to live chat now. There we go. So why does it do that? So I'm just having to look at why it does go onto top chat for some strange reason. I'm not sure about YouTube. I'm just getting used to it, guys, so forgive me on that. And so let's just dive into client FAQs, just so I don't lose any rhythm. So the first one was VAT. And interesting enough, quite a few clients are doing refurbishments on projects that they've purchased. We are seeing a lot more people buying commercial properties, and the reason why people are buying commercial property, I did a video last week on this one, talking about VAT. So make sure you go back and watch that one. That was a really interesting video where I looked at buying commercial properties, because the SDLT is cheaper than buying residential properties. You don't have the 3% surcharge, for instance. And when you're buying these commercial buildings, when you convert them into residential, which is what a lot of clients are doing, the VAT rate on the direct materials and the direct labor decreases from 20% to 5%. So not only are you saving on SDLT, but you're also saving on VAT as well. And that's something I was saying very much more detail in my previous video. So a lot of questions were asked around that. Some of the people are asking about questions on HMOs. So if you're converting a single let property into a genuine HMO, house of multiple occupancy, whether that's for professional let or for students, then the VAT rates can be dropped from 20% to 5%. I just noticed this isn't particularly manly cup that I'm drinking from, so I hope you don't mind. But it's a warm day, I've noticed. I don't know about you guys, but it's been quite lovely outside. A bit rainy on and off, but it's been quite nice. So yes, the VAT rate, great thing for converters. So commercial to residential, HMO, or singlet to HMO, 5%. And that's VAT on direct materials and labour. And the thing to bear in mind in here is that you would have to have your tradespeople clearly need to be VAT registered. And the reason for that is because they would all be the ones to reclaim the 20% VAT on the materials, so that they claim back the VAT, and then they charge you for the entirety of the labour and the materials at 5%. So you do not need to register for VAT. You can't claim back VAT. You have to get your tradesperson to buy and fit those materials in your conversion. Again, commercial to residential, they have to buy and fit materials. From single let to HMO, they have to buy and fit materials for you to be charged 5% VAT. And it's a VAT notice 708 if you want to go into a bit more detail, but you can always pop over to our previous video to see a bit more detail. Something else that keeps popping its head is the deed of trust. Deed of trust is a legal document that basically says, I want to change the ownership and the beneficiary interest of a property. Now, why might you do that? Well, you could have one person that's in a relationship, and I'm talking about married or civil partnership here. So you've got one person over here who has a good job, high rate taxpayer, and has 50% of the property income. Now, their other half, their better half, if you like, may not be working, or they're taking a part-time job, which means they're a basic rate taxpayer. And because of Section 24, this person's going to be paying even more tax than ever before. So the deed of trust allows them to say, well, I'll go at 1% of income, and the 99% will now be to my better half. So the better half now gets all the income, and potentially they could still remain a basic rate taxpayer, where this person now has less taxable income. Section 24 doesn't affect them. A couple of things you need to do here. If you've got property where it's 50-50, you need a deed of trust, which is a legal document. Optimise accountants can do these for you. It's about £299. And then we'll do the Form 17 as well. Now, interestingly enough, I just said about Form 17, but I didn't even say what that was. So the deed of trust is a legal documentation, but then the Form 17, when you've got a property that's 50-50, you need to notify HMRC that you're changing it to be other than 50-50 shareholding. So what you're going to say is, well, okay, I need to do a deed of trust that says it's now from 50-50 to 1% and 99%. And the deed of trust needs to be supported by this kind of Form 17. Both need to go off to HMRC for them to acknowledge it. And then that's the job done. And when you do your tax returns, then obviously you use those new percentages. You do need to speak to your banks. I'm always kind of wary of your terms and conditions of your mortgages. I don't want to see people go against their bank's wishes. So make sure you have a good chat to your bank and find out if they're happy with it. Most banks should be, in all honesty, but you just need to be careful. Your terms and conditions, you're not breaking them in any way. So do that before you do anything else. And a lot of people talk about limited companies. Again, an interesting insight in terms of the thought process of people using limited companies. And I've just done another video today, which will be live in 4 weeks' time. I have to do a lot of production stuff. A lot of time and effort goes into these videos. I was quite surprised of how much I have to spend editing these things. Anyway, moving back to my point here. Limited companies, is it worth it? Well, I'm not going to go to too much of a diatribe about limited companies. Is it worth it? Because I've done another video. Watch out for that in the next 2-3 weeks. You will be notified, so make sure you press the subscribe button and the bell to be notified of that one. That's going to be a 1 in 4 series about limited companies. I've had to break them all down, unfortunately. But the interesting thing when I was writing that out, some of the snippets I was talking about is taking tax efficient wages and dividends as well. Now, I'm going to just go on to an example here. Let's imagine that you have no other form of income in your own personal name. The only income you have is in your limited company. That could happen if you're given your job, or for instance. Now, what you would do is you would take, and this is for tax year 1920. So tax year 1920, this applies to. You could take out £8,628 worth of wages out of your company, and that'll be tax-free, providing you've got no other form of tax income, okay? I'll just mention that. But the 8628 is it's a bit of a peculiar number, isn't it? Because we know that, well, we may know, but the personal allowance from 18 and 19 is, sorry, 1920. I'll get my head wrong on this. Your personal allowance between 1920 is 12,500. So why am I not telling you to take wages of 12,500 out of your limited company? And I'm proposing that you only take out wages of 8628. Well, the reason for that is because you don't want to be charged national insurance. Once you go over that magical 8628, teeth in, once you go over that 8628, your company, your limited company, has to pay 13.8% national insurance, so employees' national insurance. And you, as an employee, would also have to pay 12% national insurance. So it really is a stealth tax that you need to be aware of. And then, so instead of using the 12,500, what you do instead, you take 8628 instead of wages. That's free from national insurance. And you would top that up with £3,782 worth of dividends. And because that's now up to your £12,500 personal allowance, you're not taxed on that income at all. To boot, you're allowed to take a £2,000 worth of dividends over and above your personal allowance to bring your total income for the year to £14,500. And there would be no tax liability for you as an individual. Now, I appreciate for most people out there, that's not enough. So you'll have to top that up with extra dividends out of your company, and that's okay. What you need to bear in mind is that when you're a basic rate taxpayer, any further dividends than what we've spoken about already would be taxed at 7.5%. That's not so bad. Whew. But once you're a high rate taxpayer, so £50,000 or more, the dividend income tax rate goes to 32.5%. That's shockingly high. And it goes up even more to additional rate taxpayers if you earn £150,000 to 38.1%. Crikey. Okay, that's a lot of tax. You need to be really mindful every time you go out. And funny enough, every time I go out with my wife and we're looking at something else, I always think, it says 20% off the ticket price. And yet I know I'm paying an extra 32.5% tax. Yeah, what fun I must be to go shopping. Anyway, let's move on. So the other kind of things that are being said from our clients is investing in a company. Is it the best thing to do? And I always tell people to think of two other things. Mortgage interest. You will be charged more mortgage interest in a limited company than you would by taking a buy-to-let mortgage in your own name. So when people say, I'm going to use a company to save tax, be careful, because you may be saving tax but pay more on the mortgage interest costs than the benefit of the tax savings you get. So you may not be doing yourself any justice whatsoever on that. So do be careful on that point. And that's pretty much the bits I want to go through the Q&A on clients. So what I'm going to do now is I'm going to go to the questions that are being set by you. So this is now the third installment of tonight. And I'm going to go through any questions. So make sure, just a couple of things for you here then. So make sure that you press subscribe and that you've pressed on the bell notification button. If you like this session, by the way, please feel free to type in the comments box what you've liked about tonight so far. That's really helpful for me because I want to make sure I carry on doing what's popular and stop doing the things that really is not that interesting. So let's do that. And if you could press the like button for me as well, if you've really got something out of this session, that would be fantastic. Okay, so I'm just going to go to the questions then. So Rob's asked a question. Hi, Simon. Hello, Rob. My training company is going to give an intercompany loan to my property company to buy it rented out. If I set the interest rate to 0, will this raise red flags with HMRC or is it okay? Now let's just have a look at the other thing. And would you recommend it's safer to set a 2.5 official rate or 1%? That's a good question. So let's just recap on what we're doing here. You may have a limited company, and in this limited company, it could be cash rich because it's a consultancy, you're providing services, you're selling products. And that's got some good cash flow coming on here. And that's absolutely fine. And what you've got is another limited company over here. And you want to transfer some money from here and move it to the property investment company. And that's okay, because this is just a company-to-company loan. And what Rob's asking the question is, well, would it raise flags if I charged it no interest at all? Well, I would always say that from a company law perspective and commerciality, you would never do that transaction, really, unless it's arm's length and it has some sort of commerciality. So I would always say charge one company 3% mortgage interest, sorry, 3% loan interest to the other company and get it to pay that each year. Because you don't want HMRC to be raised flags. I don't think HMRC would look at that transaction and question it too much. But I think from a company perspective, legal, being a director of both companies, there could be a bit of a sway there. I would always go with 3% and then be done with it. Charge it 3%, and then your buy-to-let property investment company's got money to invest in property. That's ultimately what it's about. So yes, you can certainly do that. The only caveat was that advice, by the way, and I've been advising a couple of clients about this now, whereby they've got this company over here, and it's for all intents and purposes a trade, services. And what's happening is that it's loaning money to this company, which the transaction itself is now deemed to be an investment. And the reason why I'm mentioning about this as an investment transaction is because of Entrepreneurs Relief. You could scupper, if you want to close this company down next month, for instance, and you've finished all your contracts with your suppliers, sorry, with your customers, and you want to close down, you could close your company down and then claim Entrepreneurs Relief, which means basically you take the money out. Let's say it was $1 million, ignoring CGT annual allowances for a minute. You could take that £1 million out and pay 10% CGT, which is Entrepreneurs Relief. However, if you've got lots of money going over here, and that's now deemed to be an investment inside this company, you could lose Entrepreneurs Relief. Is that too much to worry about? Or maybe, maybe not. You just need to be aware of that loss of Entrepreneurs Relief because of this transaction being created. It's now an investment. It's no longer, or all the money that's tied in there is no longer considered to be a trade. Therefore, the Entrepreneurs Relief does get lost. So it's not a great way to be, unfortunately, and you do have to bear that in mind. But it's a great question, to be fair. So I think that's, yeah, it's something for you to consider at least. Now, the one thing I was going to say, Amanda's asked a question, do the savings you make by being a sole trader outweigh the risk of being personally liable? Good question, Amanda. I think this is, this question pops up quite a lot, and people use limited companies because limited companies itself is a separate entity from you. And again, a video that I've just done today, which again, I don't want to repeat myself, I'm not the BBC. That video will be launched out in about 3 weeks' time. But to answer that specific question, if you've got income in your limited company, something goes wrong, the liability stays with that limited company. Okay. So if something tragically goes wrong, let's go for an example here. You have a tenant and they was walking by your property, even a member of the public, just walking by one of your properties, and a tile falls off the roof and bang on top of their head. And the insurance company looks at you and you look at the insurance company. Who's going to be picking this up? Well, the insurance company never wants to pay out, so they're going to look at you first. Did you maintain the property to the high standard? Who knows? So you, as an individual, if that person who died, their parent, their family sues you, then ultimately you could be personally liable for that insurance claim if you don't get your insurance to pay. In a limited company perspective, if something happens in the same scenario, the sued, which is the limited company, could lose its assets, but you are distant from the limited company and you would be free from that liability. It can't come after you for anything else. We are changing to be a bit more American though, so whether we will start to see the fact that you've got this whole sue the director of a company now and then they become personal liable, I'm not sure. But right now, Amanda, I would say that the benefits of having things in sole trader versus the risk of being personal liable, I think you've got to weigh that up and look at sort of the risk itself. If I was creating a product which is risk hazardous produce, then I would definitely have that in a limited company, but no two ways about that. If I've got a buy-to-let property portfolio and I know I'm maintaining that, for instance, and I've got good maintenance every kind of 6 months to make sure everything's okay, then I would probably keep it in my own name and not worry about that too much, but I would make sure that I've got sign-offs through all my maintenance checks, and I've also got sign-offs in terms of the insurance as well, making sure they're happy with what I'm doing from a maintenance perspective. So I wouldn't be too worried about that necessarily. So it's something for you to bear in mind in here. My question is at the first on the top page, please. So Gary, I'm not sure where your message has gone then. So apologies for that. It's my thing is gone. Okay, so Gary, I apologize for that. I've just scrolled back up and I can see it now. So the question that I had there was, I'm developing a property in a garden to rent using mortgage in a primary property. Can I sell the land with planning to my limited company and the finance obtained is drawn cash tax-free until loans are paid off? And that's an interesting one. So we see a lot of our clients that have purchase a property and they've got a huge back garden, and what they do is they section that piece of the garden off and then they will sell that to the limited company, build a house on top of that, and then dispose of it. And I think to answer your question, Guy, you can certainly do that. There's no issues with that. And in many reasons, it would be advantageous for it because one, it's a development project. There is definitely more risk with that kind of projects. So minimizing your risk around that would be sensible. So limited company is better. You would have the property in there. So let's say that the garden was valued at £50,000. Technically speaking, you could argue, or not argue, as long as it's not too big, the land would be covered by your private residency relief if it was your own garden. So you wouldn't have any tax on that. But then if the land is now in the limited company, you develop it, you make £100,000 worth of profit, then you could close down that limited company, claim entrepreneur's relief, and then pay £10,000 worth of tax, which is 10%. So you would benefit from entrepreneur's relief on that particular example. One of my clients, before they became clients, made an unfortunate howler. And I think their accountant before just advised them really badly. What they advised was to have the property and in the garden and to sell the new house as an asset to claim capital gains tax. Well, unfortunately, they developed a land in the view of making profits, and HMRC are very clear about this. if you've got an activity whereby you are considered to be a developer, which in this example they would be, and they was in view of making profit, which there was, then it would be income tax, not capital gains tax. So this poor sod had 40% income tax liability plus national insurance. I mean, that was a headache to go through. So Gary, hopefully I've answered it, but yes, shield it away from yourself, put that piece of land in a limited company, convert, build it, develop it, set it on, and then close the company down, and hopefully you should be okay. Johnny OC has been, I'm not sure what it's gone out of order. It has gone out of order, and I'm not sure why that's happened. So apologies for this. Maybe it's just me not seeing it right. It's because I've just realized it's on live chat or top chat, and I think I screwed up on choosing the wrong one. Anyway, I'm still getting used to YouTube. Can you tell what an amateur I really am on these things? I really do apologize. I will get my stuff in gear for next week, I promise you. Some good questions coming through tonight, and I appreciate this, by the way. It makes it a lot more entertaining for me to be able to answer these, and rather than talking to myself, which I do lonely in the darkened room of my bedroom. But let's keep on going on, otherwise people might arrest me. So I could reduce the income tax otherwise incurred and building my own name. Yes, I answered that. Johnny OC said, Motley Fool are hammering BTL in favour of investing FTSE 100. Very dubious. Do you know, John, I'm going to have to agree with you. I think whenever a critic really writes on an article and says that you should invest in a different stock market, stock markets are really high right now, and if we are talking about this going to be a bit of a correction, then surely the FTSE 100 is going to take a dip as well. I know it's not connected to property necessarily, but we all live in cycles, and I think that's going to take a dip as well. That's just my view. Have London suburbs houses peaked in value? That's a good question, Johnny. Not sure. I think they could have done. Any further Brexit effects to consider before buying the 1 million region? Wow, what interesting enough, I've been talking to estate agents, as you probably would expect me to do so. And their views is that house prices around the 250,000 marks, they're moving quite quick. They're not stopping at all. And under that bracket, I would say that's where buy-to-let investors are anyway. They're not really going to be going for more, otherwise you'd lose your return investment. So I don't think there's going to be much of a slowdown there. Interesting enough, they are saying that between 300,000 and 700,000, there is definitely a slowdown. And that's because of Brexit. That's the middle managers that have got jobs that, maybe not so secure. But then you've got those people that are earning 750,000 to 2 million. And their positioning is, well, they're maybe not middle management and therefore don't have too many fears around Brexit and are more entrepreneurial. Maybe, I don't know, I'm just guessing. But, they're not middle management, for sure, not earning that amount of money. And therefore, their risk exposure probably can be managed. And therefore, those type of houses still moving. So to answer your question, John, I don't think it's too much of an issue here whatsoever. Let's just have a look. So Rob's asked another question about trading companies going to give intercompany loan. Talked about that already. I've got all through these. Sorry. Let's move through. So Rob Smith just said, very useful. Thank you very much, Rob. Get a like on there for me, please, if you haven't done so already. If I've helped you out, please put a like on my video. Motivates me to stay on. Okay. So let's just go through, do you need a company loan agreement? I always say that if you're going to do something whereby it's two companies are involved, whether that's company A, company B, or person A, person B, I would always, always, always say that you should leave some sort of legal documentation to say that this agreement's going in place. So yes, make sure you get a loan agreement in place. Interesting enough, what I'm going to do for you is I do have a document which I'm quite happy to share with you. So just bear a second while I'm peering down on the screen. I appreciate eye contact. It's really important, Rob. So I won't be too long when I'm doing this, but I'm certain Here we are. I'm going to share this document with you, Rob, so you can use this between your intercompany loan. There we go. So if I do that, I'm not sure what I've just done. Show chat. Here we are. Show chat. Here we are. Wow, I've got it working this time, Rob. I'm not too much of an amateur, he says. But this is my loan agreement, so feel free to use this. I probably should have said what it was. So above is a loan agreement, and hopefully you can all use it. If you've got joint venture partners or you're doing stuff with other people, then make sure you do use that. It's very, very good. And away you go. So let's have a look what else we've got to say. Hope you'll skip my question. It's the fourth on the question. So Jeremy, I am pretty bad at this and I'm getting better. So I will scroll up to your question now. So let's have a look, Jeremy. Do you know what? It's not showing it. Why is it not showing your question? I'm on top chat. I've gone into live chat and let's have a look. I still can't see you. That is bizarre. So Jeremy, if you don't mind, I am really sorry, but I can't see your question on this list at all. I may be going off on tangent here, but I can't see it. So please, please, please do get your questions to me. So I'm going to stay on here for another couple of minutes anyway. So if you do kind of got any questions, make sure you answer those now. By the way, are you finding this useful? What bits do you like? Do you like the, and just say, abbreviate the answers, okay? But do this for me. Do you like the news section? If you do, just type in news and I'll know that that's what you mean. Do you like the client FAQ? So if you do, put FAQ. Yeah. If you like that, put FAQ. If you like the open Q&A, just put Q&A. And then I know which sections are more popular than the others. And equally, since you're sitting at home and you're wanting to get as much value out of me as possible, well, I completely understand that. I'm your slave. Please type in the comments box what more I could do, or what I could introduce into this section. Like, could I interview someone for you? Would that be useful to interview a client or interview someone like, you know, from a mortgage broker or something? So feel free to type those in just to help me improve this channel to be even better next time around. Indeed, should I wear a jacket and a tie? I don't know. Should I wear multicolored top and a less plain background? Things like that, dark things, but you know, just to entertain us as we do these sessions. That's what I want to see. Let's have a look. So there's some questions. Oh, some more questions coming in, I think. Rob's asked a question. I'm not sure if I missed this. Please assume I do not have any plans to use the property as security to a guarantee repayment. Does the solicitor or an accountant need to do anything with those two, please? I'm not sure. Don't think so. Not really. You skip my question. Let's just go back. So repost. Cannot see questions either. Yeah, I can't see it. Jeremy, what's happened? I'm really gutted. No problem. I'll type it again, please. Please, I'll hang on. As long as it's not 11 o'clock tonight, you know, I will hang on for that. News. Okay, good. Do you know what? When I did the news stuff, when I was reading it, I often thought, well, could I be the new newsreader for the, what's that channel, that comedy channel on BC2? Have I got news for you? I thought I could do a bit like that, but I'm not funny. So, you know, go figure. No, that's fair enough. I'm glad that, so news, FAQ, Q&A, oh, good. That's brilliant. That's what I like to see. Good. So come on there, Jeremy, over to you. No tie. Okay, Johnny, I'm right on it with you. Don't worry, there's no tie going on in there. Tech regulations, I will try and do the regulations. Got to find that, Johnny, when I've been reading those kind of stuff, it's been a bit boring. But I will try my best with more regulation stuff, if that's what you would like. I think that's, I'm just waiting for one more question. And then I'll come on to that. Like I say, I've got some questions. I've got some videos coming up, and I've done a 4-part series, by the way. So be on the lookout for that. I'm talking about section 24 on this Thursday's release. that's going to be an interesting one, because I do think about limited companies quite a lot in that as well. But I do focus on Section 24 and how you might be able to mitigate it. So make sure you stay tuned for that on Thursday evening. I will be doing that. And then the other side to these type of events as well, on the Thursday. Oh, actually, come into it. I'm going to interject on my own conversation here. I'm not sure why I've done that. Xero, QuickBooks. I'm doing live events on Wednesdays now. This is a new live event on Wednesdays where I talk about using Xero and QuickBooks. And I'm going to start to drip feed some systems in there. We've got Making Tax Digital, so we all know we're going to use them. But I do think that using accounting software, that shouldn't be just seen as for accountants, but this should be used for your management of your business. So I'm going to really focus on that aspect of financial control, generating as much wealth by financial reporting. And that's my focus on these Wednesday Q&A. So if you're around on Wednesday evenings, feel free to join me on those. Now I'm going to get to the questions now. So Amanda's just said, Rob said, sorry, had this bit of my Qs too. Do I have to officially register my intercompany loan with Companies House? No, there's no need to officially do that. You don't need to do a debenture loan or anything. Just keep a loan agreement between the two of you. When you're doing your limited company account, it will be shown as a company loan. It's not an intercompany loan unless it's one's owned by the other. So you can call it an intercompany loan if they are technically owned by one another. Amanda found everything useful, especially the news and Q&A. Brilliant, I'm pleased. Regarding my question, if I retain the property to rent, will money drawn from the company be all tax-free as the loan's paid off? Oh, okay, so if you build to rent, then should you even use a limited company? I'm not so sure, because back to my point of that you'll be paying more mortgage interest rate costs inside your limited company. You do have this issue of the insurance and risk, but maybe you want to manage that risk and look to keep that property in your own name. Depending on your tax situation though, so I'm not going to go too much detail about that. Oh, I see. You booked a 1 hour session already. Okay, fair enough. I won't go too much then. I think it can be dealt with quite nicely with the tax advisors on that kind of question. So, fair enough. I shan't contradict what they might say. Jeremy, I'm not sure what happened with your question, but look, I'm going to do type in your question, Jeremy, because I'm going to be disappearing off in the next 2-3 minutes anyway. But Jeremy, please, please, please do type in that question. If you've got any question that I haven't answered for anyone else listening as well, feel free to type in your in the comments box below, and I will make sure. Oh, it says here, my question could be too long and got booted out. Okay, sorry. Well, Jeremy, try again, and I will put it up. So everyone else listening, as well as Jeremy, if you have any questions that I've not answered tonight, feel free to type those into the Q&A box, comments blocks below, and I'll make sure I get to answer those over the next day or two. Johnny C said, what's your opinion on buy-to-let mortgage option? I'm upsizing so large amounts of stamp duty to pay off own residence, renting out current house. Ooh, yeah. Don't rent out your own house. Really got to be honest. I think the issue is that when people are buying the renting out their own house, and John, I feel for you here because I got stung myself. You've got a property, it's your own home. You move into a different property and then you rent this one out, thinking it's a great idea to hold on to it because the percentage looks valid. And unfortunately, because of Brexit, we may not see that up value. I don't know. No one has a crystal ball. But you are paying this extra 3% SDLT surcharge on the new property that you're getting. Now, if you're renting out a current property, that's okay. But you still got this whole issue. If you don't sell that property within 3 years, and then you buy another property in the future, you've still got this high percentage of SDLT. So you've got to be very careful with your decision making around your existing portfolio and then selling it on. So please be careful with that one. I think that's something that you have to bear in mind on that one. Listen, guys, thank you ever so much for tonight. Hopefully it's been useful. Like I say, do press the subscribe button, do press the bell notification button as well, because we will be releasing new videos. I'm currently scheduled to release at least one video, but it could well be that I'm going to, hi for you, Johnny. and we will talk about, hopefully I'll have a white wall as well. That's what I'm aiming for, because it doesn't look too grey. You know, it's grey, it's not nice, right? It's typical accountant. I'm not going to do it. I want the white, and I'm going to try and get my logo on there as well. So I'm going to cover 3 sections as usual. So I'm going to do in the news, I'm going to do client FAQ, and I'll do open Q&A as well. I'm going to get some polls going on in here as well going forwards, because I understand how to do those now. So I like a bit of geeky stuff as well. So I'm going to try the geeky stuff with the polls and get some interest from you guys to find out what you're thinking about as your property investment strategy. So thank you ever so much for joining me again, guys, tonight, and have a fantastic week. I know it's Monday, so we've got a long way to go, haven't we, to the next weekend. Have a fantastic week, and best of luck on your property investment journey, and see you again soon. Take care.